Hello, everyone, and good afternoon, and welcome to today's Dairy Signal episode. We are back for another market update with Ben Buckner. Ben is the Chief Grains and Dairy Analyst with Ag Resource Company. Want to remind everybody that to take advantage of the next hour we have with Ben, and please ask any and all questions that you may have. Also, a reminder for those that would like, we do offer a quiz for CEU continuing educational credits. So please look out for that and take the quiz after the episode concludes. With all that said, I am going to hand it right over to Ben to get started for today's episode.
Okay, well, thank you, Amber. Thank you, everyone. A pleasure to be back. It has been a few weeks, but it does feel good. Feels like being home again. And I guess we kind of start with one that we think the dairy outlook, especially the outlook for dairy operations is pretty positive. The milk markets have found balance. We're going to be producing an incredible amount of milk, I think, indefinitely everywhere, but you can see and feel how fast we're making products disappear to the point where we'll talk about the complete absence of product stocks building, which is pretty telling. So I think both the bulls and bears will have their days, but and it's still like managing forward risk, but I think we have opportunities to do that. That's only being done on market recoveries, and those will happen periodically, including the last couple of weeks. I think we'll see, both we analyzed kind of the summer contract market. We could see both $17 class three and $19 class three several times in the next quarter or so. So you kind of know what to do. It's not terribly complicated to us. You buy it low, you sell high, etc. In feed markets, we are kind of the same mindset where, it's fundamentally these markets seem oversupplied. And so income over feed costs, we think, are going to stay pretty elevated relative to the last decade. So things look pretty good. I would just kind of start out, though, with saying, we started 2026 on the Dairy Signal and just kind of analyzing, talking about very high level stuff. One of the things that we discussed was kind of our expectation that there would not be meaningful raw material inflation because crude oil was stuck between $50 and $60 a barrel. Then we have since gone to war with Iran, and crude oil is now, $90 to $120 per barrel. So things have changed with respect to that. And I think too, and we'll highlight the details here, but everyone can see charts being presented, the correlation between things like wheat, soybean oil, corn, and crude oil, and it looks pretty robust, those correlations. And the speculative mindset too, I think, is one of entertaining broad-based inflation, which of course, because energy prices are going to be up. So kind of like in 2021, it is the question that we've got to answer or think about is, does corn become a hedge against rising fertilizer or the rising basket of goods when we think about the totality of prices? In the mindset so far, I think, especially since February 1st, has been more or less that is the case, but we'll get into the details of why we think that may not be the case and why we're still pretty positive or optimistic on milk income over feed costs. But the big picture themes, and these have been the case for the last 6 weeks or so, but the dairy markets, I think, are kind of perfectly balanced. We're making a lot of stuff disappear. Stocks are not abundant. At the same time, there's really no urgency to ration that incredible demand that we found, and we'll explain why. And I think it's just because there's really no fear that we're going to run out of raw milk anytime soon. And a lot of the foreign markets, the competitors that we see, production growth there is accelerating. So not going to be any shortage of milk. We're still kind of awash in it. But at the same time, the consumer who has found this newfound plateau of demand for protein and even fat is kind of absorbing anything else that we're producing on the margin. The thing that we are kind of monitoring, though, I think, and why we do want to be very cognizant of volatility, thinking about forward margins, balance sheets, I mean, even extending this idea into Q1 2027. We have seen European milk production, for example, grow almost every month for the last 9 months, and pretty incredibly so, 5-7% year over year. It hasn't really meant much for cash dairy pricing in Western Europe, one of the largest exporting regions on earth, until the last couple of weeks. So we're seeing a pretty rapid extraction of risk premium in the European cheddar market specifically, to the point where it seems like the price of cheddar in Western Europe is kind of targeting the US market and wants to get back maybe the market share that it lost 2023 to 2025. None of that's happening now. But we do want to, if you take anything away from this, it's just thinking about foreign production being very high, foreign prices falling, and that is kind of unique to the last 18 months. So, and we'll revisit this every 2 weeks, of course, but it has happened more intensely the last couple of weeks. The cash market, the cheddar market in Europe going down. Feed markets, I think you can see pretty easily, we have been tied to crude oil and whether the Strait of Hormuz is open for normal vessel traffic or not, to the point where when we think about marginal intraday changes in something like corn, you narrow down your chart to 10 minutes, and it is almost tick for tick, corn, wheat, soybeans following the marginal price change in the crude oil market, which makes sense. These are all tied together. A lot of these are algorithmically, especially in the Board of Trade. You create a computer program to follow crude, look for headlines, and that's what the markets are doing so far. But when we kind of take a step further and look at cash markets in the U.S., globally, those markets have been more or less unfazed by what's happened since February 1st. And I think that's going to be our North Star here when we think about season average corn, wheat, protein meal prices. We are not seeing compelling evidence really to change our tune, at least about one, adequate to oversupplies. That's different from price discovery, but I think I'll show you that, as tight as the correlation between corn and crude oil has been the last couple of years, corn very often divorces itself from the energy market when corn supply and demand is loose, even if crude supply and demand is tight. And so is that something that we deal with? I think Mother Nature will answer a lot of those questions. But here's where we are. And this does not look like a calm milk market. But to us, I think that this is relative calm. This is very volatile. So April class 3 has traded in, $1.60, 70 per hundredweight range for the last 6 or 7 weeks. And the early part of this volatility, the first couple of weeks of February, it was very chaotic. And it was very difficult to know what to do when you'd see the market rallying $1 per hundredweight, limit down the following week. But I think that the stage has been set. And this makes a lot of sense to us. Depending on which side of the ledger you're looking at, if it's production, I think, and you isolate production only, it looks very bearish. But then when you kind of can start to fine tune back into what was made to disappear in terms of butter, whey, cheese the previous month, that looks very bullish. And so you can see that both sides have had leverage, almost by themselves, kind of alternating weeks. And so this makes sense that fair value is in this very wide range, but it's very, very hard for us to be bearish of milk below 16.5 spot, $17 basis summer contracts. It's also very difficult for us to identify, what ammunition exists to propel something like September above $19 a hundredweight. I don't think we have evidence for that just yet. Something probably has to change fundamentally from what we've seen, and we've seen a lot, whether it's incredible production growth of milk everywhere or incredibly large butter exports, cheese exports. Butter stocks are down from last year, which has been a big surprise. But that's, I think, all built into the current structure of the market. And so something else has to be presented to us to change what we think is fair value, even if it's in this $1.50 a hundredweight range. So looking at this chart, we've only isolated April here, but again, it's pretty clear you know what to do when you're at certain levels. $18 plus April, if not hedged, that's a fine place to do it. And if you're an end user and you see 30 or 40 cent corrections, that is a place to extend coverage. And again, uncomplicated is kind of the word that we use for dairy. And also, I don't know if this is good or bad, but dairy markets have really been completely separate from energy markets. And I think that makes sense because another thing that we're thinking about, the dairy markets have been maybe a little more closely tied to financial markets. And that is something that we want to talk about here is, what's on the other side of this conflict in Iran, or what's on the other side of sustained $5 per gallon gasoline prices, $100 crude, economic contraction, food demand contraction, especially in the Middle East and in importing countries. So I think that's why we've not seen, milk and to some extent sort of live feeder cattle, not follow crude, not really participate in this broad inflationary based trends, because I think we're starting to get a little concerned about demand growth on the margin. But for now, at least all known data, again, making a lot of things disappear. Demand for US dairy is pretty incredible. And I don't think that changes in the first half of 2026. And something that we have visited, periodically on the signal is these numbers look very good, but I think we can identify pretty easily why that is the case. And I think we started this process something like 18, 24 months ago when you could see, these really ultra bear markets develop at least periodically, short term in the US dairy space, including cheese, class three. But then you take a look at the world market, and all of a sudden, US cheddar is 80 cents per pound below New Zealand and Europe. And simultaneously, that translated to this incredible pace of cheese exports, butter exports, total dairy exports as a whole. So in January, the US officially shipped 230,000 tons of cheese of all varieties. I'm sorry, of all dairy products. That is up 11% on last year and the highest on record for the month. And I think something that you're going to see in a lot of these graphics, whether it's exports seasonally or total US disappearance on a monthly basis, I think what jumps out is demand's very good, but also we're not anywhere close to seasonal peak global or US dairy consumption. In the US, that typically happens in May and again in early fall, kind of the school returns. And so we still have to contend with, I think, even higher demand rates if we avoid economic issues, over the next 6 or 7 months. So demand's very good. Probably it gets better. This butts up against very large production, but the market, again, pretty balanced. Current cheese prices, the theme is, finding lots of interest from the importer space. And again, I think based on the snapshot of US cheese prices where they sit compared to competitors today, that's going to continue for another quarter. Cheese exports, it's pretty clear here. Something happened, June of last year. And really to us, it was just US cheese being very, very cheap compared to competing origins. In January, the US shipped 52,000 tons of cheese. That is also up 11%, also a record for the month. And seasonally, even ignoring last year's incredible pace of cheese exports, it's not until June that there's really any kind of change in the rate of US cheese export disappearance. What you're seeing here, calendar year 2024, that general trend really stretches back to the mid 2010s. So we're going to get rid of even more cheese in the export space, and we'll keep an eye on the European market, but I don't think they're going to disrupt us just yet. Butter has been the big surprise too, at least in terms of the New Zealand market not really falling despite large production. Neither is the European market until recently. And so if you're an importer and you want to save money, it's pretty clear to us that you're buying butter from the United States more than you've ever done so in the past. Total exports about 30 million pounds the last couple of months. That is double the previous year. We're net exporting, 18 or 20 million pounds. And so philosophically, if you think about this, that is being added to the monthly demand number. Whereas, a year, 2 and 3 years ago, you were adding 5 or 10 million pounds to the supply side of the monthly balance sheet because we were a net importer. So things have shifted pretty considerably. To the point where butter production is growing, but it's more than offset by total consumption. And I think the change in total demand of butter this year to last year so far is completely rooted in export disappearance. That has been the big surprise and what is unique to the last 6 months in butter. Total butter consumption, we can pretty easily back into it, at least in January, was 206 million pounds to 19 million pounds on last year. Production in January was up only 4 million pounds. And so you kind of know that these stocks reports are going to present pretty tight US butter supply and demand. And no longer are we concerned about cash butter prices staying below $1.40 per pound. I think they're pretty fairly priced, at $1.80 to $1.90. And we know something we've talked about the last several years is the price of butter, the timing of its peak can stretch from August to November, but it's not going to peak until then. So I do think that we still have to contend with a very tight US butter market come Q4 of 2026. American cheese disappearance, 504 million pounds, 4% on last year. And again, like butter, probably not peak disappearance. Again, like I said, that tends to happen kind of late spring, early autumn. College football coming back, for example, thinking about the physical state of these markets, we're going to have to produce lots of cheese. It's happening, but again, that's kind of why we say, December, November of last year, it was all on the supply side of the dairy balance sheet. Too much was going to grow. We were going to build stocks, and that's shifted because we've made a lot of this stuff disappear. Consumers have, and so markets are pretty balanced. And so this is kind of what we're left with. And I think this does give us some measure of upside potential in markets across the board. Cheese stocks and cold storage on February 28th, 785 million pounds is down 20 million or 3% from last year. Last year's cheese stocks were not overly abundant. And so the cheese balance sheet, on a daily basis today is not robustly supplied. It is pretty tight. And then butter, kind of in spite of having dropped to $1.25 per pound for a couple of days in late 2025, not amply supplied either. Butter inventories on February 28th, 254 million pounds, down 17% from last year. This is kind of unforeseen in the marketplace just 60 days ago, and we know that we're going to continue to build butter stocks for another 4 or 5 months. But I also think that based on still pretty firm butter prices globally, that number on June 30th is going to be 20 or 30 million pounds below where it was last year. So the butter market, like it is all the time, it's always got its eye on the holiday baking season. And do we have less than 185 million pounds of butter in storage November, December? It's hard to know today, but I think we're going to rival the tightness of the butter market last year. It's not going to be a lot of butter available to the market, I think, in calendar year 2026. Separately, we're looking at what's been pretty clear demand for protein globally, and we all know this by going to the grocery store, seeing ads. Everything has protein in it, and working with some of the bigger producers at AgResource, we can identify a lot of this is the kind of the highest protein whey concentrate, to the point where it's been very, very difficult, becoming challenging to sort this stuff. And there are really no price discounts if you're trying to source high protein whey concentrate into the end of 2026. That itself can always change if the market does become imbalanced. But I think that does give us a snapshot in that any protein that is produced, if we isolate whey especially, is being absorbed completely by the market. So whey stock, 62 million pounds, end of January. That's up 4% on last year, but it's still historically pretty tight. Non-fat dry milk stocks, also slightly above 2024, but down 30% from last year at 215 million pounds. So the non-fat dry market, which was incredibly oversupplied a year ago, solved all of its issues through a combination of producing less. The market wasn't giving us incentive to produce more. It also has found demand because protein, fat, very much in vogue here. And I don't think a lot of this is going to change. I don't think the whey market's got to go ration supplies just yet, but I do think that whatever is produced additionally on the margin will be absorbed by the consumer because protein is in everything now, and it's very, very highly sought after. So then the question is, again, we can kind of alternate between things looking very bullish and things looking very bearish. Why have the markets been kind of slow and there's been no urgency to what we like to say, no ration available supplies? And you're encouraging production, rationing demand through high prices, or you're doing the opposite via low prices. So those are the extremes of the ag markets. So why is the dairy space, milk in particular, been kind of blasé about what's been happening demand-wise? And I think that this shows you what's been going on. You still don't have, like in 2023, for example, fear in the marketplace. And that's right to us. And I don't think that does emerge in 2026 unless something changes pretty dramatically on the production side. We're still producing lots of milk, and the year-over-year changes, of course, will be getting smaller, but that's because we're comparing now to numbers that were very large a year ago. So U.S. milk production February was 18.3 billion pounds. January's production was revised upward by about 40 million pounds. And I think more than the details of outright milk production, it's the cow herd. And so the beef market is starting to show signs of expanded production. And by that, all I mean is in the month of February, placements on feed were up year over year for the first time in a while. So maybe we're starting to solve this beef issue, but it's going to take, 12, 18 months to really accomplish that task. But for now, the beef market's still giving incentive to people across the spine of the US, Texas, Kansas, the Dakotas. Reason to hold on to cows, keep coal rates low. Beef prices are going to encourage to us kind of this sustained record large milking cow herd. And it's still growing month over month in some places. Even Wisconsin's cow herd's now up 25,000 head from last year at 1.29 million. We're seeing kind of every month additional cows needs 2 to 5,000 head in places like Idaho, Kansas, Texas. And this makes sense. I mean, the price of milk is above break even by a pretty wide margin for some, and the price of beef is still encouraging crosses, and I think that stays in place for another 12 months at least. So we've got this base from which to keep milk production levels very, very high through the balance of 2026. And seasonally, this does not work all the time, but you don't tend to peak cow herd numbers for a calendar year until about April, and that makes a lot of sense. But thinking about that, we're probably not at peak cow herd size just yet. That probably doesn't happen for another 30 or 60 days. So the market can kind of see, end users are pretty well aware of this. And so you can kind of see what's ahead of us. So we kind of assume that maybe we're going to add, let's say 3 to 10,000 additional cows to the milking herd the months of March, April, and May. Per cow growth, still very high. It's averaging about 1.5% over the last 12 months. And so we do that basic arithmetic. We're still looking at production growth year over year, the next 3 months of 2 to 3%. Peak milk supplies, which is not insightful. We all know this, the end user know this, but there's just going to be a lot of milk available to the market until we get into the summer months. So I think that helps explain why there's not been urgency in the market to go to $20 class 3 because of the demand numbers. The other side of the ledger is still, like I said earlier, if you isolate this by itself, it looks very bearish. It's the collision of those two things that have kept fair value where it is in this very wide range. And all this makes pretty fundamental economic sense to us. Also, even the milk production data from February and January, it's such that you've got to once again raise your annual production forecast unless you were to tell us that, in fact, we are going to liquidate something like 120,000 cows from the herd. So I don't think that is probable. So the basic math to us is that most likely, and I think the USDA does this, if not in April, probably by May, have to raise its 2026 annual U.S. milk production number to 235.2 billion pounds. That is up another 500 million from its forecast in early March and up 1.5% from last year, which is still at the upper end of the range when we think about annual growth over the last 2 decades. So this is something we've highlighted, almost every 2 weeks for the last, 6 months, but milk production is very, very robust. And we don't think that that changes. I think that is the message that we want to communicate is, it's a lot of milk being produced today. I think that continues for the rest of 2026. So you can keep this balance in place unless something changes. And kind of on the other side of this is, we have seen in the physical data, the milk market, like all commodity markets that are ruthlessly efficient, does balance supply and demand pretty quick. And so to make that happen in 2026, we've got to add to exports a little bit, but we've got to add to domestic use if we are to keep things, the U.S. milk balance sheet balanced like it has been the last decade. And so we think that to make that happen, we've now got to consume something like nearly 224 billion pounds of milk on a fat basis. This is a very reasonable number. I think we're going to get to this no problem. But if you think about this, from a high level and longer term, you can't lose the demand that we have found. And we found it pretty easily, but there's just not a lot of space to have something else happen, whether it's competition from Europe or economic slowing because of high energy costs. And so there is kind of, to some extent, this burden placed on the market to keep this demand in place. Got record production. We have seen record demand so far, but that has to continue. And the way that continues is, at the very least, reasonable prices, end user profitability, etc. And so then that I think also explains what's happening. And when we think about pricing on a weekly basis, there hasn't been a lot of excitement, and that's the reason why. And in the background, and like we started this out, this hasn't meant much for the ins and outs of CME milk prices on a weekly basis, but things may be starting to change if we cross some kind of threshold. So now you've got sustained production growth in all major exporting countries, including Australia, where it was absent in 2025. The European Union plus United Kingdom producing 30 billion pounds of milk in the month of January. That's up 5%. And production growth is accelerating in New Zealand, the world's largest exporter of butter. Production there was about 2 million pounds, about 4 billion pounds, up 6% from the previous year. And so I think in those markets like the US currently, the consumer has absorbed all of this production growth, but we are kind of seeing evidence that maybe Europe is building this surplus of cheese. They're still the largest exporter of cheese, but we have pretty easily and consistently eaten into their market share the last 24 months. And I don't think any of this changes short term. Again, I think between now and June, the US is going to be an incredibly large exporter of cheese. But you can see that this graphic looks different. And if you've been a part of the signal the last 3 or 4 months, it looks different than it has. So until the last couple of weeks, European cheddar, pretty firmly priced above $2 per pound, very, very large premiums to the US market. But all of a sudden, that premium in Europe compared to the US has dropped to just 15 cents a pound. And the break has been pretty intense and pretty quick. So I think all this means today is that there is this kind of hard fundamental cap in the spot US cheddar market at $1.75 or $1.80 per pound, which in turn just keeps milk class 3 fairly priced at something like $18 when we think about the next 4 or 5 months. But unlike a year ago, that is a pretty hard fundamental cap. You can kind of see in this graphic that the price of cheese in Europe has been pretty strong resistance in the US cash cheddar market. It hasn't really mattered for most of the last 36 months, but things have begun to change. And so it's something that I'll keep an eye on every couple of weeks when we get this new data. The euro getting weaker, that does not help the price of cheddar in Western Europe. So we're kind of preparing ourselves maybe for more competition for exports second half of 2026. But in the short term, I do think there's kind of evidence to support very, very good milk prices, and I think a pretty dramatic improvement from January and February. And so the correlation between class 3 and physical milk checks is not overly tight, but it does exist. And so I think that given to fat demand is larger than we thought, fat prices have recovered pretty quickly. There is still going to stay this premium of $2 or $3 per hundredweight in the physical all milk cash price. So then we kind of back into, we kind of know March and April are going to be somewhere between 19 and 20 and a half dollars per hundredweight. $20, 20 and a half, $21 cash milk prices probably through the middle part of Q3 2026. So all this is going to improve, get better very quickly. And overall, we don't see a lot of evidence to disagree with USDA's annual price forecast, which is about 1970. And if you were to assume that we know what cash milk was, the first 2 months of the year, we know what we think it's going to be probably through the end of April, and then extrapolating the CME forward curve, you get to about $19.80 today. So the USDA, really the last couple of years, has been forced to raise its cash price forecast at times pretty significantly. But this year, I think might be one of those years where they're about correct. It's not a bad price. And again, I think the message here is that there will be a premium over class 3, whether it's $2 or $3, we will debate. But we do think cash milk prices will be improving starting kind of early, middle part of spring, and probably stay that way through at least October, November of this year. So we've got something like, we'll round it up to $20 all milk cash prices, and we still think that the feed markets don't have a lot of room to run to the upside unless there is pretty major central US drought or drought in Europe, China, or the Black Sea region. The market's bet since February 1st has been on inflationary trends. And so thinking about, get into your hedge fund mindset. So you want to own hard stuff. And it's pretty clear that that has included wheat, soybean oil, and corn. Crude above $90 has been the focal point, I think, of US grain futures pricing over the last 4 or 5 weeks. But if we can peel back a layer, we think that ultimately corn, soybeans, wheat will dislodge themselves from daily, weekly headlines, energy price discovery. The one thing missing, I think, from general food market inflation is we can't identify, even in USDA data, no balance sheet is tight today. And this is very different from where we've seen crude oil at or above $100 in the past. In 2007, prior to a pretty crippling US recession, crude oil nearly touched $150 a barrel. But at the same time, just isolating grain fundamentals, the US corn balance sheet was not tight. It was not perceived to be loose whatsoever. And the world had to contend with the tightest ever US and global wheat balance sheet. So I think the rally in corn and crude oil were both explainable, but just by different things. So they both coincidentally were driven by supportive market fundamentals. 2022, we're kind of in the middle of one of the more bullish periods in recorded ag history. Crude was very tight. Crude oil went to $130 a barrel in 2022, and corn was $7 and $8. Crude oil because we thought we were losing Russia's ability to produce and exports. Corn because we thought we were losing Ukraine's ability to export corn. And also there just was not a lot of corn on earth. The markets were very, very tight then. So I think that the crude oil relationship is more correlation, not causation. And again, the USDA has to us at least, present a tight grain balance sheet for this for corn simply to follow crude oil higher. Otherwise, again, I think it's going to divorce itself from crude oil market daily, weekly price determination. We're also climate patterns. So that's going to be determined by Mother Nature, whether the corn, wheat, soybean balance sheets loosen or tighten in calendar year 2026. The growing season has only started in Texas, Louisiana, and Mississippi. So we're not even to the point where we can visit any yield forecast, but outside of the western US plains, where concern is growing, it's really the only glaring threat that we're seeing. So we'll kind of touch on, and I think this is important from a big picture standpoint. South America's growing season just about over. They have avoided threats of any kind. It's raining in the Black Sea region, European soil moisture adequate to abundant, and I suspect that what drought exists in the Midwest US is going to be ended in the next 2 weeks or 30 days. And so what are we left with? And I think it's Mother Nature's job to tell us whether corn goes up or down fundamentally. And I just wanted to show you, this is what this looks like. So we can kind of isolate crude and corn oil the last 3 years, maybe 4 years, and it looks very, very tight. They do exactly the same thing. If we stretch that correlation back to 2010, you can see pretty clearly that it is positive, but it is not tight whatsoever. This is not a strong correlation. And so you want to think about the details. Here, when crude oil was at $100 in 2014, corn was at $3.50 a bushel and stayed there. So again, I think that our guiding light is always going to be fundamentals and the balance sheet for both. But does corn's balance sheet, can it change in 2026? And this is all up to Mother Nature. We are open to any kind of weather patterns. We've got to grow big crops, of course, but I think without a meaningful threat, corn's going to be about where it is today, and crude oil can go to $130 barrels without impacting the fair value of corn in Wisconsin and physical markets anywhere. The one issue that we do have to, I think, contend with is that it's fertilizer, and we don't know what this means, but because, something like 20+% of the world's nitrogen-based fertilizer is produced in the Mideast, a lot of it in Saudi Arabia. So it's transported via the Strait of Hormuz, which is, as of yesterday, closed. The price of urea has doubled. This is FOB New Orleans. And what does this mean? And, surveying ag resource clients, and, we've seen this in the media, but everyone seems to be pretty covered. And I think people that we have talked to, a lot of them are physically covered. They've got stuff. there's really not an issue. That is probably not the case everywhere, but to us, it is going to be significant if war lingers into maybe even the middle or end of summer, because we've got to do all this over again. Of course, applying fertilizer in the northern hemisphere during autumn, but also South American corn planting starts about September 20th. So if we don't solve this issue by then, I suspect decisions will be changed based on what you're producing. And in a place like Argentina, particularly, where you've got really strong crush margins for soybeans, but also they can produce a lot of corn like they did this year, does that ratio switch if urea is not available or if it's very expensive? This is, I think, the one catalyst why the Strait of Hormuz closure could impact corn longer term. I don't think it has a meaningful impact this year, and those could be famous last words, but and part of the reason is even if we don't apply maximum fertilizer or desired amounts of fertilizer to the 2026 crop, we won't know yield until we get checks and we determine a trend. That will be the first half of October. So it's just kind of a long ways away to stay long of corn because fertilizer prices are expensive. So this lingers in the background, but it's not really a focal point of our risk management strategy in grains on either side, whether you're buying or selling. We also think this is different than 2022. High crude oil prices, high corn prices, war in Ukraine. We thought we had lost 30% of the world's wheat surplus, 20% of the world's corn surplus, and kind of a sizable portion of crude oil exports. An exporting country was disrupted by Russia's invasion of Ukraine. This is kind of the mirror image of that. So one thing that we are concerned with is demand in the Middle East. You can kind of even start with tourism to the Emirates and Dubai. Certainly, I think this is going to be negatively impacted. There's also a market. It's not a huge market when you think about India or the US or China, but it is one of the markets that's been growing faster than others because of tourism. So does that get disrupted? Actual food consumption. But also quietly, Iran is the fifth largest importer of corn on earth. And in the 23-24 crop year, imported 10 million tons of corn and growing. So you can kind of extrapolate by 2026, 2027, Iran's corn import needs would be 11 or 12 million tons. So it's a pretty big number. Is that going to be disrupted? Now, virtually none of this corn comes from the US, but Brazil, Ukraine, are they allowed to ship corn to Iran, the Middle East? If not, where does that corn go? Competes with markets that we already have, including places like Latin America, the Caribbean. I also wanted to show you just the Mideast. Of course, it's a desert, but a pretty sizable importer of all kinds of food, from vegetable oil to protein meal, wheat, corn, barley. Overall, about 92 million tons of the stuff in crop year 25, 26. So we think that this is not a supply issue for grains. This is a demand issue. And so at Ag Resource, we've just started to think about, what's on the other side of this. Economic contraction in the Mideast, can't physically access things like protein meal, vegetable oil, corn. For now, I expect Chicago Board of Trade corn, soybeans, bean oil to be tied to crude for the next couple of weeks, no doubt about it. Geopolitical risk, hedge against inflation, but when we think about season average annual cash prices, this is kind of a negative to demand from our side. We are concerned that the Mideast stops growing in terms of imports and food consumption. And already funds have established if this is a hedge against inflationary trends or just war risk, you want to own physical things. The fund position today, the net position is very, very long. And so we think that, doing our daily counts as of this morning, the managed fund community is net long in the major ag markets in Chicago, something like 465,000 contracts. Corn, wheat, and soybeans. And if we add livestock to that, it's probably closer to 620 or 630,000 contracts. And so this is starting to rival the ultra bull markets that we have seen that have been driven by Chinese imports, droughts in South America, droughts in the US. This position is what it is. It means very little to us except for maybe at extremes, but there's just a lot of market length that's been established in the last 45 days because of what's happening in the market. If this thing were to get resolved, if we shift focus to anything else, favorable weather, demand contraction, does this go away pretty quick? So I just don't know what the room is for additional hedges in corn against inflationary trends. Just wanted to communicate that a lot of this has already happened. It's in the rearview mirror. I think importantly, when we think about, what's the fair value of corn, given all of this geopolitical instability and uncertainty, and I think one of the issues we've got is we do not know how this war in Iran evolves. It does seem like it's been very, very difficult to predict wars in general since the Gulf War in the early 90s. Anytime anyone thinks they can accomplish something quickly, that has not been the case. Russia's invasion of Ukraine is supposed to last 3 days as well. It's been ongoing for 4 years now. The U.S. involvements in the Middle East previously, it's just very hard to predict this stuff. I don't think I'm saying that it's going to be short or long. It's unknowable. So we check on cash markets. Those are by far, and maybe the only real proxy when we measure actual supply and demand. So we've seen the addition of premium in Board of Trade prices across the board. We've seen virtually no movement or negative movement in South American cash crop markets. So CBOT wheat up 14% from January 1st. Russian wheat's up 5%. CBOT corn is up 4% from January 1st. Argentine corn, physical corn in Argentina that you can buy today, is down 6% from where it was January 1st. So the general mentality, I think, of the global feed market is still one of large supplies, which the USDA is telling us exist. Favorable weather and this need to clear stocks, not ration demand. So the Board of Trade, its price is always perfect because it is what it is. But our concern, I think, is that it hasn't really taken much to start to shift corn, wheat, and soybean demand, from importers to other markets. And I think that's what lies ahead of us. It's not going to be determined this week, next week at the Board of Trade, but ultimately we see export demand slowing? Do we see very large physical supplies available in South America from now until October, November? Those are things I think the market will also have to contend with. It's not just high crude, war in the Mideast. To the point where we look at our corn balance sheet, and you may not remember this from a month ago or 6 weeks ago, but we've made zero changes. I don't think that we can make any changes. The one fundamental change is perhaps fertilizer, where we're very uncertain about this. Ethanol margins have improved because gasoline is very expensive, but we're kind of constrained by ethanol capacity. And anyway, the weekly numbers we get from the EIA and monthly numbers we get from the USDA in terms of corn grind present the same picture. It's very good, but we're still about 50 million bushels shy of what we need to meet the USDA's forecast. And so I think we're still left with, whatever it is, 2.2, 2.5 billion bushel in stocks. That still correlates very strongly with the $4 cash market, where the USDA is, where we are. I think we'll lose 5 million acres. Oil seeds will be the crop to plant in 2026. We're carrying over 2.5 or 2.2 or 2.0 billion bushels. And the message is still the same. There are a lot of numbers here. Some of them will be incorrect, but the theme is whatever your forecast is for 25, 26 US corn in stocks, it will be the same number in 26, 27. So ours is 2.5 billion bushels. USDA's is 2.1. It will be 2.1 next year, I think, according to USDA, come May and June, unless you lose more than 10 million acres of planted area, or if yield is below 177 bushels an acre. Both of those are possible. But I think the most probable scenario is we're assuming trend yield, shift to 5 million acres, maybe 6 from corn, soybeans, other oil seeds, and we're left with an adequately supplied corn market. So then the question is, do we have both adequate to abundant corn supplies and higher prices? I guess that is possible, but it seems like we've got to have one or the other. Either the balance sheet has to tighten or the market's going to do what it always does, and that's kind of seasonally start to extract weather risk premium May, June. That has always been the case the last decade. And so can we even separate what corn is doing this week from what it typically does in the month of March? It tends to go up. And so I think that we've got to be cognizant of that. If we're an end user, we would wait for corrections. And if we're a producer and we're seeing anything like break even, above break even revenue, I think something has to be done in the market with respect to hedges. Because we're kind of checking off a lot of risk boxes. And I know war in Iran dominates now, crude oil, Strait of Hormuz. But I think equally important longer term is that South American growing season has come and gone. No issues. This is vegetation health as of last week compared to average. Compared to last year, it looks very good in central Brazil and Argentina. So trend above yields across the board. The Argentine corn crop is being harvested. Currently, it should reach about 30% complete in the next 2 weeks. So the risk of supply dislocations there has fallen pretty substantially. Record Brazilian soybean crop, and those are kind of locked in at this point. So again, it's something we have to contend with when we think about feed pricing. The only remaining crop to grow in South America is this winter corn crop, which, if you remember, is planted in February after soybeans are harvested. Pollinates, really stretches from maybe the end of March through the first week of May, harvested in our summer. So it's kind of March, April weather that matters most when we think about yields being up or down. And it's rained in abundance in northern Brazil since February 1st. And this is the 10-day forecast. And I've highlighted the principal winter corn production belt, and it just looks very, very normal. So Mato Grosso, the state farthest north in the circle, by itself produces half of Brazil's winter corn crop. I don't think we're looking at an early end to the wet season, and yield risks are pretty diminished after about April 20th. So if we can get another 2 or 3 inches of rain between now and then, I think that crop will be as big as it was last year, and that implies overall South American production will be the largest ever by a couple of million tons. Something else that just exists in the background as we think about war, the Strait of Hormuz, the value of crude oil. And so far, we've got physical data. The Argentine corn harvest last week was only 13% complete, but the Buenos Aires Exchange every week gives us very detailed yield reports. 8.4 tons per hectare, that is up a little bit on last year, which is kind of important given the USDA, for whatever reason, is projecting yields to decline year over year. They're at 7.07 tons per hectare for the final count so far. And I know it's early, but that is misaligned with what's actually happening in Argentina. So do you add 3 or 4 million tons? Does the USDA have to add 3 or 4 million tons to the Argentine corn crop? And so that gives us just this incredibly large supply in South America. So corn could be $5, but there's also going to be the most corn that's ever been in South America. And I think that will be pretty aggressively priced. So this is what that looks like. Again, can we have higher prices and record supplies? I think over the next 12 months, the answer is probably not. We've got to have one or the other. Mother Nature in the Northern Hemisphere is what tightens the U.S. corn balance sheet. Also, thinking about cash markets, kind of against crude oil, war in Iran, and you can see here the blue line, let's focus on. They are up next in terms of having new supply. The Argentine corn market has dropped about 50 cents per bushel when we think about FOB premiums in the last 45 days. So every week you lose a couple of pennies. It's worked to drag FOB premiums everywhere else down just a little bit. And this is getting to the point where the current discount of corn in Argentina is about 20 cents per bushel compared to the US Gulf. It's not a huge difference, but historically that is one of the larger discounts we've seen over the last 10 years and looks very different than it did a year ago. So I think that the reason people are buying importers are buying US cheddar is because it is very cheap and they can save money. I think the same becomes true when people think about corn between the US and Argentina come summer. You're saving money by buying corn from Argentina, not the US. So I do think we're going to see shifting grain trade flows. And soybeans, which are very reasonably priced for the producer. We have got to use record amounts of soybean oil for renewable diesel. That is because this biofuel policy, we think, is going to mandate something like 5.2 billion gallons of biomass-based diesel to be used in 2026 onward. It's a very big number. But we can solve all this. So I think if we think about, final in stocks of soybeans to us being 320 million bushels, and in the last 45 days, we have taken our export number down because the Trump-Xi meeting has been postponed to the middle of May. We're not sure if they're going to talk about soybeans. I think the market's optimistic that they will. We just don't know. But in any case, we think we're going to have adequate carryover, higher acres, trend yield. And even the soybean oil demand issue can be solved. So we think the crush next year will be about 2.66 billion bushels. It's just mathematical formula. That's going to give us something like 32 billion gallons of soybean oil produced. That will satisfy the blend mandate. the soybean oil market will be a little tighter next year. We just don't think it's terribly exciting. So again, balance sheets to us have to change one way or another, kind of to embrace this lasting bullish feed market outlook. And going back to Argentina, soybean harvest there starts in April, probably gets going in earnest about April 15th. But I wanted to show you they've got very, very good late season rain. This is actual gauge measured rainfall recorded from May 20th to the 24th. Kind of a godsend, 2 to 4.5 inches in the heaviest concentrated soy area. So that crop will be very big. In the South American market, kind of like the Argentine corn market or the Russian wheat market, still behaving like it needs to clear supplies. So the U.S. Soybean market in New Orleans is about 80 cents per bushel above the Brazilian market. So we're going to see kind of all non-Mexican countries buy Brazilian beans instead of U.S. soybeans, which is very common during spring and summer. That's not unique or insightful, but it is going to happen again. I wanted to focus on this one little black dot you see at the very far right end of this graphic. That is the Argentine soybean FOB premium. It is 55 cents under the Board of Trade. So it looks like Argentina is both going to have enough soybeans to crush, export something like the fourth or fifth most soybean meal on record, and also export something to Asia and China in terms of like actual soybeans. So South American soybean markets have not followed crude oil. They've kind of done the opposite, at least in terms of premiums in the last 30 days. So there's a lot of soybeans on Earth. Now, we will be watching this pretty closely. Drought coverage is not small. It's getting worse in Kansas, Nebraska, Oklahoma, and Texas. That is, I think, the one weather threat that we can identify as, the meteorological spring really approaches. But in terms of the principal corn and soybean belts, we're not as concerned. So, extreme drought is still present in Illinois and Northwest Ohio, but I think that gets solved maybe in the next 10 days, because what you're seeing is incoming rain kind of April 1st on the dot. It's going to rain 2, 3. Some models have 4 inches of rain, Iowa, Missouri, and everywhere east of the Mississippi. So I think soil moisture probably not a huge issue to us come Midwest planting season. And just as an aside, we're kind of now every 6 hours looking at, will there be a new threat that changes this kind of neutral to bearish feed market outlook? And not yet. I know it's very, very early, but just wanted to highlight that even in the Black Sea winter wheat belt, which is highlighted here, kind of abundant to adequate rainfall in the next 10 days. This portion of southern Russia that's highlighted, that is the Russian wheat belt. And you can see 1/2 inch to up to 2.5, 3 inches the next 10 days. Actually, is going to go a long way for that wheat crop to make its way into end of May or June without much issues, unless it gets incredibly hot. So again, it looks like another year of pretty unremarkable weather, trend yields, etc. Does that get disrupted? It's the big question during summer. So here's kind of where we are. In these price models, we've kind of isolated the September WASDE, and we have these for every single month. But what does the USDA present in terms of U.S. supply and demand of corn and soybeans? We focus, of course, most intensely on stocks as a percent of consumption. That correlates pretty strongly with the price, at least provides you kind of a benchmark from which to build other price models from. And here's kind of where we are. And these are more or less to what's been presented in the USDA's baseline and outlook conference numbers. So this is not a major deviation from the market's perception or the USDA's perception on 26, 27 balance sheets. Something else I want to highlight here is this has built into it all kinds of geopolitics, varying crude oil prices. It is just the price of December corn and November soybeans in the middle of September when that September WASDE is released. You kind of see here that we've got to pull, the USDA has to present stocks to use much tighter than they have so far, I think, to keep markets where they are unless there's a weather problem. So to us, if they raise or present soybean in stocks next year because of larger acreage, it's something like 400 and 450 million bushels. Again, going back to 2006, whatever the price of crude oil, whatever geopolitics are in place, that has meant a $9 to $10.50 market, just before harvest in Chicago soybeans. So I think that is still the principal risk in the ag markets. Corn as well, we've got to pull this number pretty far below 10% to be real bullish of corn or have fear of supplies. Otherwise, we've been stuck for most years the annual supply and demand, certainly the September WASDE has presented U.S. corn stocks juice between 11, 17%. You can see how everything's clustered together. That means corn, like most years, is going to be $3.50 or $4 per bushel. Again, we've seen all kinds of crude oil values, geopolitics in the last 20 years, but this is what the market has done in each of those years. So I still think that harvest lows will be considerably lower than the current market unless there is a weather threat. So again, we want to be prepared for this, especially on the corn, soybean production side, but even when we're thinking about feed coverage. And I think it makes sense to be patient. As corn ultimately dislodges itself from crude oil, supplies are ample. We know physical supplies are ample today in the US and South America. It's left to drought, Midwest drought, to change this, we think. So here's kind of where we are. Again, I wanted to say it's hard to separate, what is corn doing? It does seem that on many days it's following crude oil tick for tick, but it's going to be hard when we do our post-mortem that corn's just doing anything other than what it normally does. So we've got on the right kind of a 4-year seasonal where the South American production, which has been growing, tends to break the market in April. We're not quite there yet, but we go back to 10, 20, and 30-year seasonals, and the corn market does tend to peak middle of April, maybe 1st of May. So in any scenario, no matter what we think about the evolution of war, I think that the benchmark guidance is that these trends more or less stay in place. And these trends exist because ultimately, even the Board of Trade is rooted in physical supply and demand. The market perceived stocks of corn being the lowest globally. Spring, summer, that makes sense. The most abundant come harvest. And so I think we want to be prepared for the markets to evolve something like this. So if you're a producer, we want to kind of jujitsu geopolitical strength into forward sales. And if you're an end user, unless you tell me there's going to be crippling drought in the Midwest, I think we've got some time. You don't go long-term on coverage until the second half of summer. So that is the spiel for today. There's a lot going on, as there always is, but I think the thing we want to communicate is we're kind of still rooted in balance sheets. Supply and demand, weather, I think that's going to be our best guidance when we think about risk management for the rest of the year, no matter what else is thrown at us.
Perfect. Well, thank you, Ben. We did have a question come through from one of our viewers. The question is the war going to impact U.S. ag more than our competitors?
I think it will impact them almost all equally. So especially the U.S. and South America, when we think about freight costs, energy costs, fertilizer, nitrogen, fertilizer supply availability, we are all at the mercy of the Middle East. Russia, not so much. They might be less impacted because they've got their own crude supplies, of course, and they can produce their own nitrogen fertilizer. But the Western Hemisphere, we are all in this together. So no, I think our biggest competitors, corn, soybeans, of course, is Brazil and Argentina. So we are in the same boat.
Okay, awesome. Thank you. Is there any other key takeaways that you want our viewers to know about as we conclude this episode?
I think it's still the case, the same story from us. Just be prepared, manage risk. That is I think even more so since we've got new geopolitical chaos. Manage balance sheets. Do not shoot for highs and lows, but just pass risk off onto someone else. And something that we want to think about, maybe it's a little early, given it's 12 months in advance. But the biggest risk I think for the dairy operations that we work with is always, just kind of avoiding the shock of like what we saw this year. December through the middle part of Q1. Dairy markets tend to be pretty myopic. They get very, very weak very quick. Let's entertain. Let's see what Class 3 milk can do in the next 90 days, but that is the time of year that we would be most active in hedging should we get the opportunity.
Awesome. Well, thank you, Ben. And we want to thank everybody at Ag Resource Company for their continued support of the Dairy Signal. And we look forward to seeing everyone next week, Tuesday. Have a great weekend.